There is a moment many people quietly experience that rarely gets discussed in traditional financial advice, and it usually happens sometime after income begins to rise. A promotion arrives, a new job brings a higher salary, or a household moves from financial strain into what should feel like stability. On paper, everything improves. The numbers are larger. The paycheck grows. The expectation is that life should feel lighter. Yet for many people, the emotional reality is surprisingly different. The stress does not disappear. The sense of financial pressure often remains. And sometimes, strangely, it even increases. This phenomenon is not simply about spending discipline or poor budgeting. It is often the result of a structural dynamic that economists sometimes describe through liquidity constraints, cost layering, and behavioral adaptation. When these forces interact inside a typical middle-income life, they create a situation where additional income does not easily convert into freedom, flexibility, or financial security. Instead, the system quietly absorbs the extra money. To understand why this happens, it helps to imagine the financial structure of a typical household as a series of financial layers rather than a single monthly budget. At the base layer are non-negotiable costs: housing, transportation, food, utilities, insurance, and basic obligations. These are the payments that must occur every month regardless of circumstances. Above that layer sit stability costs. These include childcare, education expenses, healthcare premiums, subscriptions, maintenance, and a long list of smaller commitments that support daily life. Finally, above those layers sits discretionary spending, which is often where people assume financial flexibility exists. At lower income levels, the majority of money is consumed by the base layer. When income increases, the expectation is that some portion of those new funds will move into savings, investment, or financial breathing room. However, in practice, something else tends to happen. The base layer itself slowly expands. Housing costs provide one of the clearest examples. As income increases, people often move into slightly larger homes, different neighborhoods, or areas closer to work and services. The monthly payment increases gradually, and the change usually feels reasonable because it aligns with improved earnings. Over time, the higher cost becomes normalized. What began as a small upgrade eventually becomes the new baseline. Transportation follows a similar pattern. A vehicle that was once acceptable may begin to feel unreliable or inefficient relative to income level. A replacement may bring a larger payment, higher insurance costs, and additional maintenance expectations. Again, each step appears logical when viewed individually. What makes this dynamic powerful is that these adjustments do not occur as one dramatic change. They accumulate slowly, often over several years. Each decision appears modest in isolation, but together they reshape the entire cost structure of a household. This process creates what we can call the liquidity trap of the middle income range. Liquidity, in financial terms, refers to how easily money can be accessed or redirected. Highly liquid money is flexible. It can be saved, invested, or used to handle unexpected situations. Low liquidity financial structures, on the other hand, lock money into fixed commitments. Many middle-income households experience rising income at the same time their financial structure becomes less liquid. Mortgage payments replace rent flexibility. Car loans replace older paid-off vehicles. Subscription ecosystems expand quietly across digital services. Insurance coverage increases as assets grow. Each commitment converts flexible money into fixed obligations. When enough of these commitments accumulate, a paradox emerges. The household may technically earn far more than it did years earlier, yet the amount of flexible cash at the end of the month remains surprisingly similar. This is where the psychological dimension begins to appear. Human beings adapt quickly to new baselines. A raise that initially feels transformative soon becomes normal daily life. Once the mind accepts a higher standard of living, the older baseline becomes difficult to imagine returning to. Economists call this hedonic adaptation. Psychologists often describe it as lifestyle normalization. The important detail is that the emotional reward of higher income fades faster than the structural costs attached to it. The brain adjusts to the upgrade, but the payment schedule remains permanently in place. As a result, people often begin to interpret the situation incorrectly. When financial pressure persists after income increases, the immediate conclusion is usually that income must still be insufficient. The intuitive solution becomes pursuing the next raise, the next promotion, or the next opportunity to earn more. While additional income can certainly improve financial stability, the underlying structure may remain unchanged if the cost layers continue expanding alongside it. This is where the mathematics of financial flexibility becomes useful. Imagine a household earning $40,000 per year with expenses of $36,000. That household retains $4,000 in flexible cash flow. Now imagine that over several years the household income rises to $60,000. At first glance, this seems like a dramatic improvement. Yet if lifestyle adjustments raise total expenses to $56,000, the flexible cash flow remains $4,000. Income increased by 50%, but financial flexibility did not change at all. The key insight here is that liquidity is determined less by income level and more by the ratio between fixed commitments and total earnings. Small increases in fixed obligations compound over time because they repeat every month. A subscription that costs $15 per month does not feel significant, but across multiple services and several years, these recurring commitments reshape the financial landscape. Housing, transportation, insurance, and financing agreements represent even larger recurring anchors. Once these costs are locked in, reversing them can require major life changes such as moving homes, selling vehicles, or restructuring debt. This explains why middle-income households often report feeling financially tight despite higher earnings. The financial system surrounding them has quietly converted additional income into stability upgrades rather than flexibility. To see the broader pattern, it helps to zoom out historically. Throughout modern economic history, the middle class has functioned as the primary consumer base for large financial systems. Housing finance, vehicle financing, consumer credit markets, and subscription-based services all expanded rapidly during the 20th and early 21st centuries. These systems were designed to make higher standards of living accessible through manageable monthly payments. From a systemic perspective, this model works extremely well. Instead of requiring large upfront purchases, households can gradually access improved housing, transportation, technology, and services. Monthly payments spread costs across time. However, the same structure that increases access can also reduce liquidity. When a large portion of income is pre-allocated to recurring payments, the system becomes efficient but rigid. In other words, the financial architecture surrounding middle-income life is optimized for stability rather than flexibility. This distinction is subtle but important. Stability means predictable payments, reliable services, and long-term commitments that support a consistent lifestyle. Flexibility, on the other hand, requires financial slack, money that is not already assigned to something. The middle-class liquidity trap emerges when stability grows faster than flexibility. At first, this trade-off feels reasonable. People naturally prioritize security, convenience, and quality of life improvements. But if the ratio continues shifting toward fixed commitments, eventually most new income becomes pre-allocated before it even arrives. At that stage, earning more does not dramatically change day-to-day financial experience. Another factor reinforcing this pattern is social comparison. Human perception of financial success rarely occurs in isolation. People tend to evaluate their situation relative to peers with similar careers, education levels, or social environments. When income increases, social circles often shift alongside it. New environments introduce new spending norms, new expectations, and new reference points for what feels normal. A household that once felt comfortable may suddenly appear modest relative to a new peer group. These comparisons subtly influence decisions around housing size, school choices, transportation, and lifestyle services. Again, none of these choices appear irrational individually. Each decision can be justified through convenience, efficiency, or long-term value. But collectively, they maintain the same liquidity constraints even as income rises. This dynamic also explains why large financial breakthroughs often feel different from incremental raises. When a household suddenly eliminates a large fixed obligation, such as paying off a mortgage or a major loan, the psychological experience changes dramatically. The removal of one large recurring payment instantly increases liquidity, even if income remains unchanged. In other words, freedom often emerges not from higher earnings but from fewer structural commitments. Understanding this distinction can shift how people interpret financial progress. Traditional narratives emphasize income milestones, earning a certain salary, reaching a specific annual income bracket, or achieving a promotion. While these markers are important, they do not automatically translate into financial flexibility. What ultimately matters is the portion of income that remains uncommitted after essential obligations are met. This is why some households earning moderate incomes feel financially calm while others earning significantly more still feel constrained. The difference often lies in how much of the financial structure is locked into long-term commitments. Recognizing the liquidity trap does not mean avoiding all upgrades or improvements. Housing quality, transportation reliability, healthcare access, and education can all represent meaningful investments in life stability. The key insight is simply understanding the structural trade-offs involved. Every recurring commitment converts flexible income into fixed infrastructure. Over time, enough infrastructure can consume most available cash flow. From a behavioral perspective, awareness alone can change decision patterns. When evaluating a financial decision, people often focus on the immediate monthly cost rather than the long-term liquidity impact. Asking a slightly different question can shift the perspective. Instead of asking whether a payment is affordable within the current budget, the more revealing question is whether it increases or decreases future flexibility. This reframing highlights the structural nature of financial life rather than just the numerical side of income and expenses. It also explains why many people report feeling most financially relaxed during periods that might seem modest from the outside. Early career stages with fewer obligations, smaller living spaces, or simpler transportation arrangements often come with higher liquidity relative to income. The total income may be lower, but the number of financial anchors is also smaller. As financial commitments accumulate over time, liquidity tends to narrow unless deliberate efforts maintain it. In that sense, the middle-class liquidity trap is not a failure of discipline or ambition. It is a predictable outcome of a system designed to distribute improved living standards through recurring financial structures. Understanding the mechanism does not eliminate the pressures entirely, but it does reveal the underlying pattern. Income growth and financial freedom are related, but they are not identical. True financial flexibility emerges when income growth outpaces the expansion of fixed commitments, allowing some portion of earnings to remain genuinely liquid. That difference, between money that is already spoken for and money that remains free, quietly determines how financial life actually feels on a day-to-day basis. And for many households, recognizing that distinction is the first step toward understanding why earning more does not always feel like moving forward.